Hello, today's class we'll be learning about understanding and managing startup fixed and variable costs. This is chapter 7 of this course, entrepreneurship. And today's learning objective, we'll learn about the cost of starting a business. We'll also be talking about fixed and variable costs, the difference, and how you should be able to identify them. Then we also try to look at some financial record keeping for your business. So when we want to start a business, the first thing is that we have to look at after all the feasibility studies and all we've measured from chapter 1 to chapter 6. The next is to look at the cost to operate a business. A business cost, it has to be analyzed before the business can be embarked on, because we don't want unexpected costs which we cannot cover up. So to run a successful business, you will need to keep track of all your costs and have more cash coming in than going out. That means your income should be greater than what your expenditure. I mean, the income should be able to cover for your profit and also be able to cover for the cost you spent in doing the business. So to actually make a profit, it's you have to know the selling price per unit, and you have to ensure that the selling price per unit is greater than the cost per unit. And this can be done by using the EOU, which is the economics of one unit. And in previous chapters we've also discussed and show how to calculate for the EOU of your business. That is a kind of a litmus test for profitability. So we're going to see what is called seed capital, which is also known as startup investment. This is the one-time expense of opening a business. It's the very first money you put into the business, meaning the money you use to rent that shop, to buy all the machineries and equipment you need to do your business. So it's very, very important. I mean, if you do not have the provision for seed money, it is quite very challenging to start up a business. But when we talk about seed money, it's not fixed. It varies from business to business. It actually depends on the cost of operating that particular business. Now, the example given here is about a small business which has to do with a kind of a small scale business that has to do with hot dog stand. Means you selling hot dogs, and this is the startup expensive for such business. You see, they are talking about the beginning inventory, such as on hot dogs, condiments, buns, and also business cards and flyers. These are also very important because you have to create that awareness to know that the business has started or it's existing. Then business license. This varies from places. It varies from one place to another, city, countries, as the case might warrant. So it's not as if it's fixed. But then, if you are starting up a business, you have to verify if the business has a license and what's the cost of that license. So this is just an example. Then, when we talk about startup investment, it varies. Okay, for just a small business, this is an example. We could also be looking at a kind of business that has to do with franchise. Means franchise, it's that you're using a name, a brand, or everything that have to do with business to run your own business for profit. So in franchise, we have the franchisor and the franchisee. So for this type of business that has to do with franchise, you must ensure you have quotation. Okay, quotation is trying to know the estimate of the cost of those things. For example, you're doing a franchise business and the equipment are going to be provided to the franchisee. So the franchisee has to ensure he knows the total estimate of he or she has a quotation. I mean, to know the total financial estimate of all the equipments that will be used or needed for that business. So you look at this is another even though some of these equipment will be provided by the franchisor. This is usually based on agreement. Okay, so if even though it's going to be provided or it's not going to be, you have to also have a quotation, trying to get a estimate, a good idea estimate of the cost of this equipment. There's sometimes when we also mention about startup investment, it could also be in type of prototype. For this type, a prototype is a model or pattern that serves as an example of how a product will look and operate if it were produced. And these days there are companies that are strictly just trying to produce prototype. Their business is just to produce prototype of the type of product you want. They do nothing else. Okay, so they are specialized on that. And this type of companies are very common in the US or in China. In this type, you have to also be sure of what it from the prototype. You'll be able to know the kind of have an estimate, okay, of what your seed money is going to be required. Usually prototype costs millions of currency, millions of money to kind of develop. So all these are various ways which seed money has to be analyzed. I mean, will be the cost of it. It could be in the case of just a small business, like the example of the hot dog stand. It could be in this case of using the franchise method of business, where you have to get the quotation, even though your franchisor is going to provide some of the equipment, all or some. And it could be in the case of where you have to come up with a prototype. So whichever case out of all of these three options of the type of business you intend to do, you must have a seed money for it, and all of these should be also listed. I mean, should be written out and should be costed, so that you don't face any financial eventuality. You will not be able to withstand any unexpected financial cost in the process of the investment. Now we're going to look at brainstorm to avoid startup surprises. Before starting your business, you have to try to anticipate every possible cost by analyzing all components and possibility. Like I've already mentioned, of the startup of an hot dog stand, of a franchise business, and also a business that has to do with prototype. Then you must also ensure you carry out research on your own by kind of asking industry, ask them what startup costs and what they didn't capture before they even started up. So they already have the experience. Probably in their own time when they were starting up, they kind of omitted some costs, which eventually when they started, they were able to know the cost actually was there. So asking these people that are in the same industry will also help capture all the costs that you might be you will need to spend. I mean, expenditure costs that you will be experiencing. So also you could also kind of research industry information and obtain quotation from potential suppliers too. Now let's talk about cash reserve. These are emergency fund and a pool of cash resources. This is very important in for a business, because when cash reserve, it actually helps to meet up unexpected costs or unexpected expenses. Entrepreneurs must prepare for these unexpected expenses because they usually come up. Okay, in short, if you don't see them, it means there's something not working okay, there's something not working fine. It should be a surprise to that entrepreneur, not seeing unexpected costs. These are unexpected things that you do not you do not expect to. I mean, they just come up in the process of doing the business. So there should be a cash reserve to meet up with this type of, they are called emergency fund. They are used to meet up with this type of unexpected cost or expenses. So this reserve will kind of provide cushion of protection if you need it, and it will be able to sustain the business, and be business as a business person, you also be able to quickly grab opportunities because you have this cash reserve. Sometimes when entrepreneurs do business, there are opportunities they have to let go because they do not have access to fund to kind of maximize this opportunity. But with cash reserve, you are able to meet with this type of unexpected expenses or cost. Then we also have the payback period. The payback period is an estimated time required to earn sufficient net cash flow to cover the startup investment. The payback period is very important because it actually, you see, timing is one of the reasons a lot of business people they fail. They do not know how to mash up their their availability of fund with their payback period. And when this happens, they are in a lot of dilemma because they will not be able, though the fund is there, but it's not available for them to for the payback period. So an entrepreneur must ensure that the payback period and the fund availability, it's okay. I mean, it's the fund is available for them to meet up with the payback period. This is why it's very important for them to be aware of the estimated time required to earn the sufficient net cash or to get the money back to cover up the startup investment. Because sometimes startup investment, the money could be getting from different friends. It could be a loan, okay, apart from being a personal money, it could also be a loan, or it could be a short-term loan, it could be a long-term loan. So this is why it's very important to have a payback the payback period. For long-term payback period, long-term loan will be able to it's okay, it's suitable for it. And for short-term payback period, short-term loans will be able to meet up with it. So when company analyzing startup costs, one consideration will be show how long it will take for you to earn back your startup investment. It's very, very important. You do not just invest, but you also have to ensure how long will it take for you to earn back the investment, the money spent on investment. And that means that you have to be sure of your the startup your net cash flow per month. I mean, when you get how much you're going to get as your net cash flow, okay, and at what period are you going to get it. So when we say payback is actually your startup investment divided by your net cash flow per month. Then looking at this, it's predict the payback period. Okay, so when you know the payback period, the time horizon is known and timing of fund availability is clear, and also it will also take into, it's also very necessary to takes into consideration future earnings, opportunities for alternative investment, or the overall value of the company. So when it's actually, this overall, it's based on net cash, and it's a good indicator of the time needed to earn back initial disbursement. Then we'll look at the estimate value. Estimate value means you have to give an estimate of your proposed investment, and financial managers use different tools to determine this. They sometimes use the NPV, and this is widely accepted and is mostly used, and because it is most theoretically sound. So this NPV is most times adopted. So entrepreneur can use this NPV to consider the financial returns on their initial investment. So if the NPV calculation should be positive, okay, if it gives a positive value, it means that the investment will result in a positive return based on the owners and investor required rate of return. So this is an example, okay, and this is NPV calculator for 8 to 9 year period, and the NPV is positive, so it's the business could be a go. Okay, so you can take a look at this slide. I remember in our previous classes, I think in your year 2 we did NPV and how to calculate it. So taking a look at these slides, you'll be able to easily understand this. The initial investment is 1.5 million, and the percentage, because NPV is calculated on the required rate of return, so it's 0.12. And the net cash share for one, at the first year they made nothing, okay, and at year 2 they made 100,000, 200,000 just in the subsequent years. And if you look at year 7, there was depreciation, there was decline in market. This could be for different reasons. It could be change of taste, style, and so many reasons, okay, possible reasons. Then at year 8 there was still further decline, and in net year cash 9, company closed down. So if you look at the NPV, you'll see that the total money was now 2.03. This 2.63,067.47 kobo, okay, 47. So this money, if you deduct the initial investment, you see you have 563. The initial investment was 1.5. If you deduct it away from the calculated present value, after year 9, you get 563,067.47. So this business, it's a yes, because the NPV is greater than $0. Now we see we also have for economies of 1 unit. This we've done before too, but this is just a total summary breakdown of how you can go about it. If you see, the selling price per unit was $35, and the cost of goods sold is $7. That is the COGS. Then we have the labor per hour, which is $10, and of hours per unit. Labor per hour is variable, cost, okay. Then okay, per unit it's 0.75, okay. Now if you add this together, you get $7.50, okay. The total cost of goods sold is per unit is $14.50. So that $14.50, if you take it away from the selling price, which is $35, you get $20.50, okay, $20.50. And going down, there were other variable costs such as the commission, which is 10%, which is at $3.50. Then at $3.50, then we have total, and the total other variable costs, which is altogether, apart from, we also have packaging, which is less than $1, so it's 50 cents. So we have total other variable cost is $4, and that $4, if you add it to the other cost of goods sold and the total labor per unit, and the total cost cost of goods sold per unit, you get a total of $18.50. So the total money would be like I think $16. Yeah, if you take away this, you get $16.50. Okay, so that is all for this one. So going on, let's look at fixed and variable costs, because from this slide we saw there were variable costs. I made mention of variable costs. And now, what is variable costs and what is fixed costs? Variable costs are not stable. They change over time. They change with the sales volume, right? They change with the sales volume, because as the sales increases, the variable cost also increases, and if sales reduces, the variable cost also reduces. So what they're trying to say is never fixed. It goes with the quantity you are producing. The quantity you produce. For example, okay, let's use a baker for example. You baking cake for 5 people. The quantity of ingredients you are going to use, the cost of buying the ingredients, if the number of person increase to 10, 50, 20, definitely the ingredients are going to increase. That means if you're going to buy more flour, sugar, milk, and whatever ingredients, or sorry, whatever items you use to bake your cake, all of these are going to reduce. They are going to increase. They are going to increase. And if you are baking for less people, maybe now you're going to bake for only just 2 people or 1 person, the items you use for baking, they are all going to reduce too. If the number of person you are baking for increases, all of the items you use for baking, from the flour to sugar, all are going to increase. And if the number reduces, likewise the ingredients, they are going to also, the items you use are all going to reduce. Definitely you're going to use a smaller size of pan and all the other stuff, lesser hours for the baking oven and stuff like that. So this is all about variable cost, but the variable cost is totally different from fixed cost. Fixed cost does not increase regardless whether sales are being generated or not. It doesn't increase whether you are giving or baking for, this time around, let's use a different example. Like for example, advertisement. Okay, whether 100 or 50 people are going to buy goods from you, it doesn't matter. One time advertisement payment you've made is still that advertisement that is going to run for you, even if 1 person is patronizing your business. And if 1 million people are patronizing your business, that same advertisement you still going to use. You won't say because you have more than just 1 person patronizing your business, you are going to increase the number of adverts. No, that same advert is still going to cover for the number of persons that are patronizing your business. So this is called fixed cost. Another example of fixed cost is also your rent, your rentage, okay, salaries. So variable costs and fixed costs are different. Okay, so we're going to look at the types of variable costs change with production and sales. Variable costs change with production and sales. They fall into 2 subcategories. We have cost of goods sold or cost of service sold. For cost of goods, we have COGS, and for cost of services, we could say it's a cost, which is COS. So each of these is associated specifically with a single unit of sale, which includes the cost of materials used to make the product or deliver the service, or the cost of labor used to make the product or deliver the service. Then we also have other variable costs, which include commissions or compensations based on sales volume, shipping and handling charges. Now, how do we calculate the critical cost? To determine calculating critical cost is to determine the most important factors with respect to cost in your business. You can calculate critical cost. It's necessary for you to calculate the critical cost because it determines the most important part. The cost that is most important to your business. Sometimes when the funds are limited or resources are limited, you must try to know which is important and which is irrelevant in terms of your cost, so that you know the one to let go and the one you have to prioritize. It will also help you to determine your profitability and the factors that can and cannot be easily changed to impact your profit and also your cash flow. Now, to calculate, let's look at calculating the total gross profit. We have to know the contribution margin. For gross profit per unit, the selling price minus total variable cost plus other variable costs. From this, you can actually use the economics of units, which is the EOU, to calculate whether and by how much you will come out ahead on your per unit cost for each sale. And also, by using the EOU, that is economics of units, you can figure the gross profit per unit, and it will contribute to contribution margin per unit sold. Now, what about if you sell multiple products? That means, for example, you're selling more than just one product, or a product has multiple parts to it from different, that means a single product. I mean, like for example, most business, they sell more than a single product, and they can also use EOU as a value measure of product profitability. But let's look, for example, that you selling a product, selling a variety of product that has different EOU. You have to separate the EOU to for each item to determine whether each is profitable or not. Then you could also be there similar product with comparable prices and cost structures. Then you could also use the EOU to determine this. That means there are many similar products and with comparable prices and also comparable cost structure. The EOU can also be used. Now, before I leave, an example of this type of issue, it's like a car. Like the cars we use, for example, though we have the different parts of a car in a car, sometimes the manufacturer or the brand itself is not the one that has produced all parts of the car. You see, the different parts of the car can be sourced from different manufacturer. There are cases like this, but whichever the case, what they're saying is that you can actually use the EOU to kind of find out to calculate this the multiple products. And when calculating EOU, when you sell the multiple product, you can still use the economies of units to determine this. Then let's look at inventory costs. Expenses associated with materials and direct labor for production until the product is sold. Like for example, if the EOU can still help you figure the cost of goods sold, or the variable cost, the gross profit for the product, although the process will be more complex, but then it can still, you still have to it's still very workable using the EOU. Okay, now this is an example of Dennis. Dennis sells sandwiches from a deli cart downtown Saturday. She sells each for $5. So the material and labor that go down into marketing one sandwich are the COGS, which is cost of goods sold. The cost of the materials and direct labor for production are called inventory costs until the product is sold. Means the product is being managed. The cost of the material and direct labor for production are called the inventory until the product is sold. Then we're going to look at fixed operating costs. We've talked about the variable costs. Now let's look at the fixed operating costs. Expenses that do not vary with changes in the volume of production or sales. I already mentioned this. Now for fixed operating costs, fixed operating costs do not change based on sales activity. Therefore, they are not included in the EOU. You shouldn't use the economies of units to calculate this. Okay. Each sandwich shop has to pay, for example, a sandwich shop has to pay the same rent each month, even though his prices or his sales is increasing or not. Whether you sell one sandwich, you're still going to pay the rent. The rent is fixed. Rent is a fixed cost. The rent still remains. And whether you're selling millions and millions and millions of making millions and millions of sales, your rent is still the same. So rent is considered as a fixed cost, and they are not included in the EOU. Although there's still a little shift in the rent in fixed cost. It happens once in a while, maybe, but it's very slow. That means, well, in this we can say it's a mixed cost, a little bit of a variable touched in it. That means after a while, and the person sees there is need to probably change to a bigger space, the person moved and changed to a bigger space, that means there will definitely be a change in the rent. Or probably the person sees there is need to probably go for a smaller space, then the person can decrease the space. So this happens, and this is why there's room for a mixed cost. A mixed cost means we have a fixed and a variable cost. Means that over time there's a little a change in the cost, it will be a fixed cost for a long period of time, a very very long period of time, and after a while it will, you have to make adjustments, okay, either increase or decrease based on the business demand. And another thing is the salaries we pay, okay. You make salaries, and over time you see there's need to increase your salaries, probably due to the government requirement, or probably due to the good job done by your workers, or probably because you feel you want to upgrade, employing more skills, more skilled personality, and more skilled persons. So there will be need for you to increase, and sometimes it could be there is need for you to decrease. So when things like this happen, you could say it's a missed cost, because it actually changed. It's like it can't be fixed forever. Now let's look at the different types of fixed operating costs. You could actually use these words to remember them, which is I said, your, plus other FCS. This stands for insurance, okay. I said, you are, plus other FCS. The I stands for insurance, they are fixed. Salaries, they are fixed. Advertising, interest, depreciation, utilities like gas, electric, telephone, internet access, right? Like looking at the internet access, for example, you use your internet, okay, no matter the number of persons that are using it, right? Whatever kind of work you've used it to do, you're still going to pay same amount. And if you decide to use it just once, you're still going to pay the same amount. I think this goes with Wi-Fi, probably, right? Let's say this internet access is the example is Wi-Fi. You're using the Wi-Fi internet access, not the mobile data. Okay. So now also rent. We also have the rent. We have the other rent. I already gave you an example of rent. Depreciation is another thing too. Depreciation too, because depreciation always occur. It's fixed. There's always wear and tear over the years, no matter what you've used it for. However, I already told you there are some times that the fix has to be shifted. It has to either increase or decrease the cost, okay, based on the business and demand, okay. Now we're moving on. Let's look at these are all what I've been mentioning the example, and also we just go through the slides. Fixed operating costs do change over time. What I already mentioned, you can read this on your own. I already mentioned how it changed over time, why you could say it's a missed cost, because it stays over a long period of time before it can actually change. Then fixed operating costs do change over time. Yeah, fixed operating costs do change over time. These are all examples. We also talk. So now let's look at the net profit. So looking at net profit, the remainder of revenues minus fixed and variable costs and taxes. Business owners like to know how much their revenue will have to be used to cover the cost of goods sold and other variable costs. So this is very important, you must know, okay. And fixed operating costs can be dangerous because they have to be paid. Yeah, for fixed operating costs, like the variable costs, it's you save with it, because if there is no increase, there will be need for it doesn't increase, and if there is decrease, it decreases, and if there is increase. But this is not so with fixed operating costs. Fixed operating costs is whether there's business or no business, you have to make payment. Like for example, you could even make a zero sales, or there could be there's zero no business, right? But you have to still pay your rent. You have to pay your rent, your house rent, your machinery rent, or your equipment rent, whatever rent. You still have to pay your salaries, right? And if you don't pay, it's considered as debt. You owing your workers. So this is why the fixed operating cost is very dangerous, because they have to be paid whether or not the business has made a gross profit or not. So this is why entrepreneurs should be careful about taking on fixed costs. You should be very very careful, but does not have to worry as much about variable costs. Variable costs, it's okay, you could easily manage it. It goes as the business goes, okay. If sales are low, the variable costs will be low as well. Now, let's talk more about the dangers of fixed costs. If a business does not have enough sales to cover its fixed costs, it will lose its money. If losses continue and it continues, then the business will have to close, because and the business will become indebted. So as we've discussed, fixed costs are dangerous because they must be paid whether or not the business is making enough sales to cover them or not. Now, let's look at accounting records to track fixed and variable costs. This is why we must know our fixed costs and our variable costs. We have to keep accurate records of the money flowing in and out of your business, and this will be is very, very critical to the business, to the success of the business. So before you can create a financial statement, you must be able to keep track of your daily business transaction. You must know what you're spending and what you're making, how you're spending it and what you are making, and what and when you spend it, and how and when you make it. These are very important. They should be recorded down. Okay, that is the best way to keep track record. You must have a bookkeeping, or a record keeping. You must cultivate the habit of writing in the inflow and outflow of money in the business. So if you do this as an entrepreneur, you'll be well ahead of many business people who are careless. You are very, very conscious of your income, because you write down, and if there's need for you to reference back, you have to go check your records and remember all what you've done and how you've done it. Then it's a thing that has to be consistent. You must keep a consistent record of your business, inflow and outflow, cash inflow and outflow. Now, moving on, there are 3 reasons to keep good records every day. The reasons are: it makes the business more profitable. You document profitability and cash position. You'll be able to show proof of payments that have been made, and you'll be able to make good business decisions, especially when you're looking for financials, you're looking for loans. All of these records, they play a very good role. I mean, you have proof, because like for banks, you want to take loan from bank, they usually ask you for your financial books records. They want to see the business, how it has been managing its finances, and what it makes. So you see, this is the reasons why these are some of the reasons why you have to keep record. Apart from your personal benefits, it actually helps with having other external benefits, like taking money, or financials too. You're looking for people to finance your business, your project. They also want to see the financial records of the business. Probably you want to present for sponsorship. All of this you can easily prove if you have the payment records. Now, reasons to keep good records every day. Another thing is audit. You need this for audit. What is audit? It's a kind of a review of financial and business records to ascertain integrity and compliance with the standards and laws of the place where you operate your business. Okay, like the US, this is a requirement from the US Internal Revenue Service. Another reason is to keep good record is to take advantage of tax deduction. You could have tax deduction if you have good records to prove this. Okay, then US tax law allows, like for example, the US tax law allows business owners to deduct many expenses from their taxes. So these are, like I already said, some of the external benefits of keeping good financial records. Now, okay, for you to keep financial records, it can be cumbersome and very challenging, but these days things are a lot easier, because we have software that can do all of these tasks for us. I mean, you don't have to tax yourself so much to try to keep these financial records. There are softwares like the Microsoft. I think some of them you can even get free ones online. You can download and use for your accounting software you can use. And these are there are excellent software programs on the market to help small business owners keep good records and generate financial statements and analytical reports. And when you keep all of these records, you can just generate reports. Whatever thing you need, statements you need, you can generate and print out. And these days it's not you don't need to do it manually the way it used to be. And some of these softwares companies, the Microsoft, this one specifically is free. You can actually download to use for your business. Then we have the QuickBooks, P3 software. Sometimes you can get free trial from some of the rest mentioned, and if you are interested, you can go ahead to purchase to use. Now we're going to use use accounting software. Like some software company offer free product. This already mentioned, and they are affordable. Even if you are asked to pay, they are affordable. They are cheap and affordable. There are a lot now, so it's easy. Okay, for a very small business, it is possible to work with a manual system, including a journal and files for story records for your transaction. For a business that is very small, you could also still use manual instead of not doing any. The manual is fine. You can use the manual. As your business grows, you can also you can add additional tools. They also have additional tools which you can use to make your work a lot easier. However, if you're intending to grow the business beyond the handful of transactions per week, you should use a good computer-based system from the start. Okay, then moving on, let's see keeping receipts and invoices. You should keep receipts and invoices. You should file them properly, keep them in a safe place. You should also duplicate in case of some get missing or there's incident. You should be able to have access to the copies. Some copies kept. You could actually keep a copy of each invoice in an organized fashion, that is numerically, alphabetically, or in order by date, and record or payments promptly. Okay, there are trained personnel for this. If you have the fund, you employ. If not, you can do this yourself as an entrepreneur, as a business person. You could do the filing yourself. Okay, you should ensure you issue receipt for sales. Okay, and also try to record sales. Okay, there are softwares for this too, free softwares you can actually use for all of this. Then apart from always keep a copy of your financial records in a location away from your business, preferably in a fire retardant safe or crockery line files cabinet. If you are using software, you should also back up your data and keep the media. Let me probably your CD jump drive, external and hard drive, etc. You should also keep this in a different location or back up to a cloud storage location. The cloud is free. You have that in your Gmail. That means your Google Drive. You can just keep your stuff there and it's safe for you. Then you should also have regular offsite backups. You will still have your financial records if anything happens to your journal or your business site. Then use business checks for business expenses. Means avoid using cash for business. Okay, to be on the safer side, avoid using cash for business, because with your business check you can actually have records. Not just you, even the bank, the transactions will be recorded by the institution you're using. Then deposit money from sales right away. You shouldn't keep money in a place that is not safe. Money should be deposited right away into your for safekeeping wherever you choose to keep them. Then let's look at accrual method and cash accounting method. Cash accounting method is a system wherein transactions are recorded when cash is paid out or received, and this is different from the accrual method. Okay, accounting method wherein transactions are recorded at the time of occurrence regardless of the transfer of cash. Whichever method you choose to use, it's fine. Okay, use the one that best suits your business. For financial accounting for business is divided between the cash and the accrual methods, and each company may select which one it will use. Then we have you have to recognize the categories of costs and know the one to prioritize. Like I told you, you have to be very careful with the fixed cost. Okay, then the variable cost, it's manageable. Then you can also look at the capital equipment, okay, investment, loans, revenue, inventory, and other costs. All this you must recognize and be able to identify and record down appropriately. So that is the end for today's class, and see you next time. Bye.